Talking about concerns over the rising federal debt, President Trump speaking out on the economy during the summit in Vietnam as the U.S. debt ceiling deadline rapidly approaches. Watch.
Our economy is incredible. Our unemployment numbers are among the best we've ever had in our history. So we have the strongest economy, possibly, that we've ever had.
Federal Reserve Chairman Jay Powell, meanwhile, also taking the hot seat on Capitol Hill with this.
We've never failed to pay all of our bills when and as due, and I think that can never happen. That's not something we can allow to happen. I think our credit rating and our credit as a country is such an important asset. I think U.S. debt is fairly high at a level of GDP, and much more importantly than that, it's growing faster than GDP, fairly significantly faster. We're going to have to either spend less or raise more revenue.
And the federal debt right now above $22 trillion. Joining me right now is the president of the Committee for a Responsible Federal Budget, Maya McGinnis. And Maya, it's always a pleasure to see you. Thanks so much for joining us this morning.
Thank you. Nice to be here. Tell
us about the impact of $22 trillion in debt. I want to get to some solutions here, but I recognize much of the growth in spending is from an area of the economy which is not easily changeable, those entitlements. So first off, give us the impact, Maya. What's your reaction to $22 trillion in debt?
Yeah, I mean, Chair Powell laid it out perfectly, which is we are on an unsustainable path where the debt relative to the economy is the highest it's ever been, other than just after World War II. And even more troubling is that it's growing faster and faster every year, faster than the economy. And this is happening at a time when the economy is so strong, which is exactly when you would expect your debt situation to be getting under control. So much of it is self-imposed. If you look at this year's budget deficit, 60% of it is from new legislation that was passed in the past 4 years or so. So this is not just, this is built in. This is Congress continues to add more and more borrowing onto the budget. But the big problem out there, and you pointed to it, the big problem is we have health care expenditures, retirement expenditures, and interest on the debt, which is the fastest growing part of the budget. Those three areas of the budget are accounting for the vast majority of all of the growth, and we're doing nothing to improve them. In fact, when it comes to interest, we're exacerbating the problem.
And as interest rates rise, that interest on the debt is rising, and you're predicting it's going to be $1 billion a day.
Yeah, the interest is the fastest growing part of the budget. Right now, we're at the point with interest payments in our budget that next year we'll spend more on interest than we do on children in the entire budget. So more just to finance the borrowing from the past than to invest in the future. And by 2025, we will spend more on interest than on defense. That is not a recipe for a country or an economy that will stay strong.
So put aside the entitlements like health care, Social Security, because that really takes a change in policy. I don't think you're going to see it during an election year. You're not going to see any administration or any side in Washington say, all right, we're going to change your Social Security benefits at this point. But what about the spending, Maya? How can we pull in the spending? What do you recommend for this Congress? Because I don't know what to say about the Republicans' discipline on spending over the last 2 years.
Yeah, what discipline? What discipline all around? So there's the mandatory part of the budget, automatic pilot. Those are those huge programs. We do need to address them. And you're right, it's going to be difficult to in this very politically heated time. The discretionary portion of the budget, there was a cap on spending there. And year after year, Congress raises the cap. But there's a big difference. The last time they raised the caps, it was a 2-year deal. They raised it to the tune of $320 billion and didn't offset any of it. They put it all on the credit card. They're about to confront that question again, which is defense and domestic discretionary spending is supposed to be at a level that's lower than really any politician wants it to be. So they're going to need to lift those caps. What they really have to do is offset the costs. If you want to increase the spending somewhere in one place, you have to offset it somewhere else. When the economy is strong like this, the very minimum they should commit to is not making the debt worse. So here's a pledge. Here's a pledge for members of Congress. We're on track to borrow $12.5 trillion over the next decade. Could they at least promise not to make that number larger? We obviously have to make it smaller, but could they promise not to add more to that $12.5 trillion?
So as you write in your most recent report, stop digging.
Oh, stop digging.
Stop digging. We're about to get the GDP report out in about an hour. Look, a lot of people are expecting 3% growth for the year. This estimate is 2.3% for the fourth quarter. But can growth help here? You know, during the tax writing legislation period, a lot of the Congress and House Ways and Means Committee members said growth is going to take care of some of this. And you say?
Growth is absolutely key, but we have massively exaggerated the extent that we can have sustainable growth. So growth is really hindered in this country because aging of the population, and there's not much we can do about that. We're getting older and we're living longer. And so within the next 10 years, 1 out of 5 people in this country is going to be over 65. That's going to slow down our economy. What it means is we should do everything possible to speed up the economy. But I'll tell you what hurts. When you debt finance something, whether it's tax cuts or infrastructure, you will actually get much less growth out of that policy than if you had offset the costs, because the debt slows growth down. So that's why we think whatever we're going to do, let's pay for it. If we're going to do spending, you have to offset it somewhere else. If we're going to cut taxes, you have to offset it somewhere else, because they don't have that growing debt load. And like you said, interest payments, if they go up, we're so vulnerable. If interest payments go up, that will cost 1 percentage point increase, costs $190 billion a year in additional interest payments. That is kind of a credit card teaser rate situation you don't want to be in, and yet our country is.
These are really important issues, and yet markets don't care about it. I mean, when the debt hit $22 trillion, you didn't see any reaction from investors.
No, the markets don't care. I think the markets are very short-term oriented, and the real issue here is we don't know when it becomes a problem. The deficit and the debt have not put upward pressure on interest rates, for instance. They're very low, and there's no sign of any kind of crisis. There's no inflation that we're seeing that's troubling. None of these things are a problem right now. And so the issue is markets are kind of focused on the immediate, and this doesn't appear to be a problem until suddenly it's a huge problem. And what you want from your politicians of all parties is to show real stewardship, which is to say, if this country is on a path that is unsustainable on its debt, on its Social Security, on the things that we know it is, instead of waiting till we hit the crisis point or the tipping point, let's get ahead because of the problem. We know how to make these changes and start to make improvements when times are good, like they are right now.
What do you say when you hear proposals like the Green New Deal? $96 trillion or something in terms of the cost, $94 trillion, according to Douglas Holtz-Eakin's group, or Medicare for All, wiping out the insurance industry, the private insurance business, and taking on more trillions of dollars in cost.
Yeah, I mean, so that what it shows is that it's completely out of touch with our budgetary situations. Listen, the objectives are great. If you want to do more health care, if you want to clean up the environment, those are all things that you can want to do. But we need to have a world of reality when it comes to our budgets. And because for so many years we've been adding to our debt and adding to our debt, we are at a point where one of the first things we have to do is bring that debt down before you can spend on anything else. Yeah. But the second thing is people pretend those programs are free. They are not. What we would have to do is pay for them with higher taxes. So tell the taxpayers how much it would cost and then let people decide, because it's a very, very hefty price tag. And my guess is once we stop pretending they're free, the support for those programs would diminish very significantly due to the price tag.
Yeah, I agree with you. Maya, it's great to see you as always. Thanks so much.
Thanks, Maria.
Thanks for your great work. Maya McGinnis joining us there.
Here's one for my finance political guys. This is from Fox Business News. America's national debt on an unsustainable path. Committee for a Responsible Federal Budget, President Maya McGinnis on mounting concerns over national debt. Last month, the national debt opens a new window, surpassed $22 trillion, or nearly $180,000 per taxpayer. That figure will roughly double within 3 decades. Since spending on Social Security opens a new window, Medicare and Medicaid will balloon as America's population ages. Such stratospheric debt levels will be completely untenable. It'd be like saddling every taxpayer with an additional mortgage on top of his or her own existing housing, credit card, and student loans. The lion's share of the tax revenue would go towards interest on the debt, leaving little for safety net programs, the military, or core government functions. By 2050, the federal government will spend more on interest payments than Social Security, health care, or national defense. If our elected leaders had been responsible, they would have reformed entitlement programs long ago and eliminated pointless tax breaks to balance the budget. Unfortunately, it's too late for a grand bargain now. Dramatically hiking taxes or drastically cutting Social Security and Medicare benefits in the late 2020s or early 2030s when entitlement trust funds run dry would send the economy into a depression. Ignoring the debt and indefinitely printing more money, as proponents of modern monetary theory effectively advocate, would lead to uncontrolled hyperinflation. Our leaders have dug us into a hole, and the best way out is a soft default on the national debt. A hard default where the government simply refuses to pay its debt would cause a global economic meltdown. Dollar-denominated treasuries and Federal Reserve notes are the lifeblood of the global financial system. But a soft default, a one-time devaluation of the dollar which enables the government to pay back its debts in full, albeit at a lower intrinsic value, needn't be catastrophic. That's something that Germany tried to do back in the 1920s. Here's how a soft default would work. The Treasury would peg the dollar to gold. Oil opens a new window. Natural gas or silver, or perhaps a basket of those commodities. By choosing a weak valuation, for instance, $10,000 per ounce of gold, compared to the current market price of roughly $1,290 per ounce, much of the debt could be paid down thanks to a much weaker dollar. In other words, you inflate your way out of your debt. In other words, you'd be paying back the same debt with cheaper dollars, which would piss off your creditors. To be clear, a soft default isn't a good idea. It certainly isn't moral. It hurt everyone who socked away money in bonds, certificates, or deposit or savings accounts. It sure would. But realistically, a default of some kind will happen anyway. Simply put, the debt load isn't sustainable. A soft default is the least bad option, and we ought to bite the bullet now before we rack up any more debt. The timing for a soft default is comparatively ideal. We have historically low unemployment and a growing economy. To prevent hyperinflation, the government would have to assure investors the soft default was a one-time occurrence and that future politicians won't repeatedly pull the same trick. See Argentina. That would require a law or perhaps even a constitutional amendment. Under normal circumstances, Congress would never agree to this plan. But if the Trump administration acted unilaterally to peg the dollar to a commodity, open a new window, basket the short-term chaos that would ensue in the financial markets, could pressure Congress to support such a law or amendment. Pegging the dollar to physical commodities would cause short-term instability, but ultimately strengthen our nation. It forced our leaders to balance the budget, since the Treasury and Federal Reserve wouldn't be able to create new money without producing an equivalent amount of commodities. The Founding Fathers favored a commodities-backed currency for that very reason. They rightly worried fiat money would lead to irresponsible borrowing. The United States could easily maintain such a peg. We have the world's largest gold reserves. Okay, I thought it was China, but I digress. We recently became the world's top producer of crude oil and have been its top producer of natural gas since 2009. We remain one of the top 10 silver producing countries. This immense mineral wealth ensures a commodity-backed dollar wouldn't leave us vulnerable to the whims of OPEC nations or major silver and gold producers. America's looming debt crisis threatens not just our economic prosperity, but our national security. 70% of all federal spending goes to entitlement programs and interest payments, leaving just 30% for the military and other discretionary programs. That ratio will become even more lopsided due to the demographic changes. By 2030, for the first time ever, there will be more seniors than children in the United States. That's what they're worried about. That's how come they keep importing children. Entitlement reform won't happen in time to stave off catastrophe. The surest way to put the nation back on sound financial footing and prevent future politicians from repeating the same mistakes that got us into this mess is to softly default on the debt. And that is from Todd J. Stein. I'm hearing a lot of this. I think this is like the third article I've seen on basically defaulting. So in my mind, and this is just my opinion, what they're saying is that this debt is unpayable. The debt as it is formed is unpayable. Much like Weimar Germany in the 1920s when they had this enormous war debt by the Western countries, France, Britain, and the United States. They had this enormous war debt. And what they did was they inflated the German mark almost to where it was worthless, which pissed the creditors off, but they basically made the German mark worthless. Much like what they're getting ready to do here, making the dollar worth 5 times less than what it's worth now. Imagine that the dollar is almost 10 times, because the dollar is at what, $12.90 versus gold, and they're talking about a $10,000 an ounce gold piece. Basically, you'd be getting a little bit better than 10 cents on the dollar in value if they did this, a soft default. It wouldn't kill trade, but it would definitely screw it up. You would no longer be the top consumer market on the planet. It'd be somebody else. And everything that you depended on would have to be made in-house, because at that rate, importing from basically you'd be almost like a third world country as far as money and wages are concerned. If the minimum wage is $15 right now, and you defaulted on your debt, and the minimum wage effectively became $1.50, which is what it was back in 1964, you'd be basically working for, say, third world wages. $2 a day approximately would give you what? $2 a day. $2 an hour would give you what? $20 a day. That may give you what? $500 a month. So equivalent of working for $500 a month if they do a soft default. And the only reason they're suggesting it, and like the man said, it's the least bad option, because the world economy is a wreck. There's too much debt in the world economy, and they can't pay it down, or it's impossible to pay it down. So now, before it gets any bigger, go ahead and default out of it, and within, what they're saying, within 5 years, pay off your debt. And whatever America is on the other side is what America is on the other side. It probably would take care of your immigration problem, because it wouldn't be worth it for people to move up here to get jobs. It wouldn't make anything. And the dollars you ship back home wouldn't be worth anything. It'd be better to stay home. And it probably mean the seniors would have to move out of the urban areas into the countryside just to survive. Also was sent an article that the world is getting ready to give it off the SWIFT system. And if anybody doesn't know what the SWIFT system is the global banking system that the dollar and the euro basically run on. And they want to change over to a Chinese banking system globally, which probably means that the SWIFT system is not functioning as it should be, and the global banks aren't in the best shape. So I've heard other, non-mainstream sources talk about the United States defaulting on its debt, much like Argentina does all the time. But this is the first time I ever heard a mainstream publication talking about the U.S. defaulting on its debt. 2019 is going to be very interesting, just a national discussion about default. And we do have a president in here that might do it. It might get the conversation started, but we will see. But with that, I'm going to jump off of here. This is BGS out, and I will see you cretins later. Peace.